Taxi! Okay, man, we're looking around. This is the 77 WABC minicast.
Welcome back, folks. We go to hour 3. We're going to do some stock market work, and we're going to do some money and politics work, and we're tracking the Iranian story that there could be some kind of deal, but I don't know. I can't believe President Trump will give up on his red lines, but we'll figure all that out as time goes on. By the way, you can live stream this radio show over the internet. LarryKudlowShow.com, LarryKudlowShow.com, and after the Memorial Day holiday Monday, we will resume Fox Business. The name of the show is Kudlow, 4 to 5 p.m., Monday through Friday, and if you can't make it at 4, just text your favorite 9-year-old. She'll teach you how to DVR the show. You'll never miss a thing. We're going out to the Reagan Library. Let's see, we're going to broadcast out there Thursday and Friday, big economic conference. I'm going to interview Scott Bessent, among many other things. Let us bring in our expert. I mean, we talked about the bull market in stocks, which is awesome. Everything's going up. Stocks going up. Earnings, profits are going up. Business is going up. AI is going up. Caterpillar's going up. Wow, this is the most fun I've ever had. Stephanie Link, Hightower Advisors, Chief Investment Strategist and Head of Investment Solutions. As you know, I've said many times, I sleep better at night knowing that Stephanie Link is still in the investment business. And Jim Lacamp, down there in Texas country, landman Jim Lacamp, who on the side, he's got a side hustle, Morgan Stanley Executive Director and Senior Portfolio Manager and Director. It's a great side hustle, Lacamp. You've been doing this for how long? We've all been doing this for how long? Stephanie, I'm going to go to you because this is the most fun I've ever had. Honest to God. Even the bad. I know inflation is high and gas prices are high, but it's like everything else is just doing so well. I can't stand it. I mean, I love it. The Kudlow Trust is doing well. What do you make of it, Steph?
You know, it's really amazing, Larry, that we've had to deal with so many things year to date, with between Venezuela, between SCOTUS and the tariff overturn, between AI and the apocalypse to software, to private credit concerns, to the war, and yet from the March lows, the S&P 500 is up 17%, and the NASDAQ is up 26%. And the entire reason is what you taught me 18 years ago, because it's all about profits. And profits have been soaring for the last 3 years, actually, but they're accelerating this year. And a lot of that is because of the consumer continues to consume, even though people don't believe that to be the case. Well, I look at all these data points that a lot of these companies are reporting, and I listen to the bank companies, and they're telling us that the consumer continues to spend. And then, of course, it is this AI revolution, but it's not just AI and the CapEx and Mag 7, it's the food chain. It is, if you believe in AI, you need more data centers. If you believe that, you need a better grid, and we haven't upgraded the grid in over 50 years. Jim's going to tell you that. He's down in Texas. They've got the worst grid. And you need power, and we don't have enough power. So all of that is fueling better economic growth of about 4% in the Atlanta Fed tracker, and earnings growth of about 25%. That's good. That's good news.
25% earnings growth is just awesome. It's completely, I mean, you're right. And you know what? Just one last point before we get to Landman. The retail sales numbers were very strong, surprisingly strong, right? And including the so-called core. But the core is up 3-month change, 9.2 at an annual rate, 12-month change, 5.7. Even the overall is 5%. So the gasoline thing, all right, I know it's bad, and I know it's difficult, and I know it's politically unpopular, but in terms of the economy, profits, stocks, it just hasn't had an effect. We're a very strong, resilient economy, landman Jim Lacamp.
We are, and to dovetail onto what Stephanie was saying, and the inside part of that is productivity, and not enough people talk about productivity, but it's absolutely accelerating. A lot of that is AI, and every day we hear about layoffs related to AI, and that is happening. But on the other side, as often happens with new technologies, as always happens with new technologies, is you have hiring on the other side. We have all the money being spent on CapEx has resulted in newer and better paying jobs. And then we have deregulation that's finally kicking in, and the Trump tax breaks that are very, very business friendly. So all of these things are tying into a pretty robust economy. Yeah, it's a little bit K-shaped, and some might even say a little bit L-shaped, but overall, it's a robust economy, and 4%, as Stephanie said, is very strong on GDP growth. So right now, you just can't quibble with the market. We're above the 10-day moving average on all three of the major indices. Every day, I screen for breakouts, and they're happening every day. And when that happens, when there's enough players out there playing that you can field a team with different industries and different stocks, then you got to play. And that means this market is still alive. There's some risk to it. The Cerberus of higher rates, higher inflation, and higher oil prices is an issue. But right now the market is the honey badger. It just doesn't care.
Non-farm productivity, last 4 quarters, 2.9%. Call it 3. That is a big number. Compensation per hour wages, 4.2%. This is the whole non-farm economy, okay? Therefore, unit labor costs, the 4-quarter change is 1.2%. Now, that's an important number. First of all, that's a profits number. Unit labor costs are low, profits are high. Second of all, in some sense, it's not only the cost of labor, but it's the basic underlying inflation rate. You just got to take it. It's not the CPI. It's just economists of all stripes understand the importance of unit labor costs. When they're high, you got a problem with inflation. When they're low, you don't have a problem. They're 1.2%. Okay, so that's very. I mean, I think just right there, it's the heart of profits, but in some sense, it's the heart of inflation too. And I think people are too panicked. You think? I mean, I know there's been a lot of talk about bonds. People are going crazy because, Stephanie, their bonds. Wait, let me look at my stock sheet. What are you, 450 on the 10-year? Hold on. 456. You're right. All right, so I would dare say it's been in a range for a year. Yes. Basically. Actually, probably longer than a year stuff. But really, are we having a big break, down 4 basis points yesterday? Is that a problem? Why is that a problem?
I don't think it's a problem here. I think if the 10-year gets above 5, you might have some switching happening. That's the only thing. So that's what we're watching. And I would tell you, so we're watching tariffs, we're watching geopolitics, inflation, Fed, new Fed, and now we're watching the Y, right? The yields part of it. But it has been in a range, which has been really remarkable, to be honest, Larry. But I want to just get back to half a sec on the earnings front. Earnings of 25%, but guess what? Revenues rose 11%, and margins actually expanded in the S&P 500 by 75 basis points. In the face of all of this inflation and this scare, right? And I would just also mention, in terms of back to the consumer, the household budgets, in terms of what they use for gasoline, it's 3% of their budget. 3% is very manageable at this point in time. The problem is you've got inflation kind of across the board in other areas. And so I would say, like, if we get an answer on the war and we get a resolution, certainly that part will help. But I will also say, Larry, that I think inflation was very sticky ahead of the war, and I think that a lot of it of it had to do with the AI boom. We have shortages everywhere right now. We're short compute, we're short memory, we're short all kinds of things in the supply chain, and that's a little bit on the inflationary side. So, and that's a short-term thing, because eventually AI is going to lead to even better productivity. But for the time being, I think we've just got to get used to a little bit higher inflation, but we have higher growth, and that is offsetting the higher inflation.
Agreed. By the way, another thing about rates, and then we'll take a break. Year to date, the 10-year has gone up 39 basis points at 456. Year to date, 39 basis points. Of that number, decomposing it, real yields, looking at the tips, real yields are up 24 of the 39. So really, that's capital returns, or let's just say economic growth. So only 15 basis points, 39 minus 24 is the inflation fear, the inflation expectations. So it's fairly modest. Real yields haven't moved in a long time, and now they're moving. You're up to 214 on the tips, the 10-year tips. I'm just saying, inflation thing is really vastly overrated. It's probably important not to read the newspapers at times like this. Jim Lacamp, you were talking about credit spreads. I think you were at the end, and I'm just looking on my sheets. The Moody's BAA spread against Treasuries year to date has fallen 13 basis points, and the Merrill Lynch high yield spread against Treasuries has fallen 4 basis points. So the so-called private credit problem, I mean, with profits so strong, but it doesn't look like it's much of a problem.
No, I think it was exaggerated. There are parts of that area that are problematic, but not the area in whole. And the high yield spreads are showing that a lot of people felt like if rates didn't come down, you'd have problems with commercial real estate. Then you had the private credit problems, but the junk spreads are saying there is not a problem. The only thing that could be a problem, crude stockpiles fell by 51 million barrels over the last month. So we do need to get a resolution here. I don't think it's too late, but I do think we need to get a resolution here, or we're going to be looking at higher oil prices for an extended period of time, because the longer they shut down those constructs in Iran, for example, it might take years for them to get production up to where it was. I don't think it upsets the apple cart, but I do think it's something that we need to pay attention to.
Well, Stephanie, your point, though, what did you say? The household budget, only 3% is gasoline. Was that your point?
Yep.
I'm not saying that nobody feels any pain. I understand some people do. But gee whiz, it's just a small part of the economy. I mean, we've changed our whole, the architecture of the American economy vis-a-vis oil and many, many other things have completely changed over the last 50 years since the 1970s.
100%. And now we know we talk about the consumer being K-shaped, but actually the middle tier is doing okay. It's the low end that is not doing that well. But unfortunately, Larry, you know this, Jim, you know this, it's the low end always gets the brunt of all of the things that are happening to them. And a lot of the reason why the middle end and the upper end are doing so well is because they have a home, and the homes have appreciated in price over the last decade or two. And they also have equities. And equities have been on fire for the last 3 years, and people feel pretty good. So it's the wealth effect on the upper end and part of the middle end, too. We want to make sure we can help the lower end, but right now it is what it is, and it's driving, it's like the 80-20 rule. It's driving the overall consumption. And by the way, the consumer is still focusing on services, which is 75% of consumption. So these are important things to watch. Oh, by the way, I would just say one thing real quick. Brian Moynihan, he's the CEO of Bank of America. He was on WallStreetJournal.com last week and said, in the month of April, the consumers were spending 5%. They have credit card data, so they spent 5%. 50 basis points was just gasoline. The rest was all over the place, he said. He said credit is absolutely tame. Delinquencies are going down. Net charge-offs are going down. And then the most important thing is their loan growth is above trend. They're running at about 9-10% loan growth. And that's what we want to hear from the banks, because that's the fuel to the economy.
That's all true. Senior loan officer surveys have been very strong, very robust, and it's very easy to nitpick and find problems. And there are potential problems out there. As Stephanie said, if rates go above 5%, that could be a problem from an asset allocation standpoint. But for now, you have to give the bull market the benefit of the doubt. All three major averages are moving. There are stocks to play. Earnings of 72% of companies beat. 74 beat on revenues, and that is huge. And so that's the major story right now.
You know, there's always corrections and whatnot, but I'm just looking at this. The Dow Jones, 50,579.70. 50,570. The S&P 500, 7473.5. And the NASDAQ's 26,000 plus. I mean, really, I know there'll be corrections, but those are big numbers. Steph, is there anything you like better than others?
I still like the AI, the industrial companies, the infrastructure companies that are actually building out the data centers. I like the companies that put the stuff inside it. Like, I like the cooling systems companies. I like the heating systems. I like the chips. I like the racks, all those. That's GE Vernova, that's Vertiv, that's Eaton, that's Quanta Services. So I still like those. They're up a lot. I wouldn't chase them, but on any pullback, you want to be buying.
Caterpillar, one of those. Somebody told me Caterpillar.
Yes, they had a backlog of $62 billion. I mean, it was crazy.
And you might add in robotics and space. There's a lot of space technology stocks that are doing well. And look, they're fighting wars all over the world over materials. So I still like materials and especially natural resources. So there's a lot of places to play.
You guys are terrific. Stephanie Link, Jim Lacamp, thank you ever so much. Appreciate it. All right, folks, we'll take a quick break.
The Larry Kudlow Show on the Red Apple Podcast Network.